The hidden reason. Your salary never feels like enough. You got the raise. Maybe it was $5,000. Maybe it was $10,000. You told yourself this was it. This was the number that would finally make things feel comfortable. And for about 3 weeks it did. Then something strange happened. The money disappeared just as fast as the old money did. The bills adjusted. The lifestyle crept up. And somehow, you ended up in the exact same place, checking your bank account at the end of the month, wondering where it all went. This isn't a budgeting problem. It's not a willpower problem. And it's definitely not because you're bad with money. What's happening to you has a name, a mechanism, and a history that stretches back decades. And the people who profit most from your financial frustration are counting on you, never understanding it. There is a reason personal finance feels like running on a treadmill. No matter how fast you go, the scenery never changes. You earn more, but wealth never seems to accumulate. You cut back, but the pressure never fully lifts. And the advice you've been given, spend less, save more, skip the coffee, treats the symptom while completely ignoring the disease. The real reason your salary never feels like enough isn't hiding in your spending habits. It's hiding in the architecture of the modern economy, in the psychology of human desire, and in a system that has been quietly engineered to absorb every pay rise you will ever receive. By the end of this, you'll understand exactly why the feeling of financial scarcity follows you regardless of your income level, and more importantly, what the people who escape this trap actually do differently. The hedonic treadmill. In the 1970s, two psychologists named Philip Brickman and Donald Campbell introduced a concept that would quietly explain more about human financial behavior than almost anything written since. They called it hedonic adaptation. The idea is straightforward. Human beings are wired to return to a relatively stable level of emotional satisfaction, regardless of what happens to them, good or bad. Lottery winners, within a year of their windfall, report similar levels of happiness to people who experienced serious accidents. The brain recalibrates. What was once extraordinary becomes ordinary. What was once enough becomes the new baseline. Applied to income, this means every salary increase you've ever received carries an expiry date on the satisfaction it generates. The 3x00 raise that felt like breathing room in January becomes invisible by March. Not because you wasted it, but because your nervous system absorbed it and moved the goalposts. This isn't a character flaw. It's evolutionary. The brain's job is to keep you hungry, to keep you seeking, to prevent complacency. That same mechanism that drove our ancestors to work harder, hunt more, and build shelter is the same mechanism that makes your new salary feel normal. The trap isn't earning more. The trap is believing that earning more will solve the problem. Lifestyle inflation, a silent absorber. Here's where it gets structural. The moment your income rises, an entire ecosystem of financial pressure rises with it. In the UK, a salary crossing the $50,000 threshold doesn't just bring home more money, it pulls you into a higher tax band, reduces your personal allowance at $100,000, affects your student loan repayments, and quietly shifts social expectations. In the US, crossing into a six-figure income changes your tax bracket, your healthcare considerations, and indeed critically, your social circle. And social circles are more dangerous to wealth building than almost any specific purchase you'll ever make. Research from Harvard Business School found that people's spending patterns are far more influenced by the consumption habits of those around them than by their own stated values. When your income rises and you begin spending time with higher earners, the invisible benchmark for what constitutes a normal life shifts dramatically. Suddenly a certain postcode feels necessary. A certain type of car feels reasonable. A certain level of holiday feels standard. None of these are conscious decisions. They're social calibration, your brain reading the environment and adjusting its sense of normal accordingly. This is why lifestyle inflation isn't really about luxury. Most people experiencing it aren't buying yachts. They're buying slightly nicer versions of everything they were already buying. A slightly bigger flat, a slightly newer car, slightly better restaurants, and the compounding effect of slightly across dozens of categories is financially lethal. A system designed to absorb your raise. Let's talk about something almost nobody in personal finance is willing to say directly. The economy you operate inside is not neutral. It is not designed to help you accumulate wealth. It is designed to convert your income into consumption efficiently invisibly, and with your enthusiastic participation. Consider how credit works. In both the UK and the US, the credit system expands in near-perfect proportion to your income. The moment you earn more, your credit limit rises, your mortgage borrowing capacity increases, and the range of financial products you qualify for expands. Every one of those products exists to translate your future earning potential into present spending. Buy now, pay later, not just as a checkout option, but as the foundational logic of the modern consumer economy. Consider how housing works. In London, New York, Sydney, and every major city where wages are highest, housing costs have risen faster than wages for 3 consecutive decades. The raise you received didn't beat the market. It funded the landlord's next rental increase, or stretched your mortgage just far enough to justify a slightly more expensive property. The gap between income and asset ownership has widened.